Hey there, Casey here. Today we're going to be talking about the MACD. If you ever wanted to learn exactly how it gets calculated and how to trade it, watch today's video. You will know everything about the MACD. All right, so the first thing we're going to start with is, what does MACD mean? Most people just say it as an indicator, but it actually means moving average divergence convergence. And if you're anything like me, when you heard it, you're like, what the heck does that mean? I have no idea. Well, we're going to go ahead and dive into it today and actually explain each thing. So the first part, moving average, okay? Moving average. Moving average is the average number of candles averaged together. It's just a simple math problem, right? 50 simple moving average is the price of 50 previous candles divided by 50. An exponential moving average is the same thing. The only difference is it's weighted to give the most recent candles more significance. If you think about it, that makes sense. What's happened recently is more important than what happened way in the past. But it's still important to know the past, because if you don't know the past, you're going to repeat the same mistakes of the past. So we want to always be learning from what happened before us, not just in trading, but in life. It's a very good principle. Look into the past. Don't live back there, but look to the past so you can learn and see what's going on, and that will help you get prepared for the future. It works in trading and everything else. Okay, so now that we know that, take a look at it. So this is a moving average right here on the chart. You can see here, there's a moving average. That line right there, that's the moving average. You can see that the moving average is calculated, and it's just those lines, whatever moving. If it's a 26, it's 26 candles. If it's 50, it's 50. This particular moving average right here, that is the 200, right? So the 200 is 200 days, right? 200 days. So that's pretty simple, moving average. Most of us know what that is. All right, now moving on. Convergence, okay? Convergence happens when the price of the asset, which is whatever it is we're trading, and the indicator move in the same direction toward each other. So let's take a look at that same slide, and we're going to give an example here. Okay, so if the indicator, which is, here's the MACD below, if it's moving up, okay, and if the price is moving up, that is convergence. They're moving in the same direction. That's convergence. When convergence is when the price and the moving indicator are moving in the same direction. One more time. Convergence is when price and the indicator is moving in the same direction. Got it? Yep, you got it. Okay, good. Now we're going to go on to the next one, which is, remember, it's divergence. So what is divergence? Divergence is when the value of an asset, indicator, or index moves, the related asset, indicator, or index moves in the other direction. So whereas convergence, it's moving in the same direction, divergence means it's moving in the opposite direction. So let's go ahead and take a look at the slide here. Okay, so now, as you may know from this slide here, that we are having divergence. And so you can see price is moving down here, and then we have a convergence situation, okay? But then what happens? It keeps moving down, but what happens to the indicator? The indicator is moving up. You see the indicator is moving up by this arrow, and you see this indicator is moving down. They're moving in the opposite direction. Price is moving down, indicators moving up, and it keeps moving further. We got another new low, right? You see this? This is a new low. Okay, and then look at where the indicator is going. So the indicator is moving up and price is moving down. That's divergence. So again, divergence is when the price is moving in the opposite direction of the indicator. Okay, and so divergence is really important. The reason that it's important is because that is an indication that the price is going to change direction. When price moves, it doesn't usually happen on a dime. It doesn't happen instantly. It usually needs to consolidate. It needs to turn the ship. It's like think of price, you know, there's billions of dollars in these markets. Think of price like a giant ship. right? And that ship isn't a speedboat. It's not going to turn on a dime. It needs a big, wide turn, and it takes a few days for the thing to turn around, right? And so that's getting some clues. It's like waves. You know, when that ship starts to turn, it starts to send out some waves. And so we get waves, we get clues, and we use the MACD indicator to help us find those things, right? So again, just to recap, we have the MACD, the Moving Average Divergence Convergence, MACD indicator. And so the great thing about a MACD is it tells you a lot of information. That's why it's a lot of the traders' favorite indicators. So now we're going to go ahead and we're going to break down the indicator, and we're going to talk about certain parts of the MACD. So the first thing is we have the MACD line. Okay, the MACD line, and I'm going to go over all of those here. Then we have the signal line, and we also have the histogram. Those are the three parts of the MACD, right? And so if you can see here, this is the MACD. I just zoomed up the indicator. You can see what everything is. And so this part is the histogram right here. Very simple. That's the price data calculated. And it's visually displayed so you can see the price moving lower. That's the histogram. And we're going to talk about what that means in a minute. Then we have the signal line. We have the signal line right here, okay? And then we keep moving on. And then the blue line is the MACD line. So the red line is the signal line, and the blue line is the MACD line. And it doesn't really matter the color. Some indicators might be different. All right, and then finally, we have the baseline or the zero line, right? So when price goes to zero and below, it starts getting red, and when price goes above zero, it's getting green. And so one is indicating selling pressure, the other is buying pressure. Green is bullish, red is bearish. And so that's the simple diagram of everything that you're going to see in the MACD. But I'm still going to go ahead and now explain how all of that actually works. And so how does it work? Well, there are three exponential moving averages inside of the indicator, right? And so here are the three. There's the 26-period EMA, a 12-period EMA, and then a 9-period EMA. So there's three moving averages. And it's not exactly as you would think when it comes, or how it's calculated. So the histogram is calculated by subtracting the 12 EMA minus this 26-period EMA. It's actually the difference between the 12 and the 26. So they take the difference, which is the part in the middle, and then they visualize that in on the histogram. And if the number is negative, it goes below the zero line and is red. If the number is positive, it goes above the zero line and it's green. And so here we have it again. We got the histogram. And so that's calculated with the moving averages. Okay, there they all are. You see them there. And so now the MACD line is, actually I'm going to talk about one other slide first. So here is these two moving averages, the 26 and the 12. I drew them on here. So you can see this gap right up here, that gap, and then this. And you see how the gap is the biggest right here, and this is where the biggest of the MACD is. So the histogram is actually the difference between the two, which is this gap. So as the gap gets bigger, the histogram gets bigger. So all it is, you really could do everything that a MACD does without even having a MACD. All you need is a 12 and a 26-period moving average. This is just a visual representation of these moving averages. That's all it is. I've totally taken this and demystified the MACD, so now you know exactly what it is, right? That's it. So you could actually trade this without the MACD, but you'll notice here where it's really dropping, and see how can't even catch up. It's really a wide spread here, and this is how it is. So anytime you're wondering how the MACD works, this is it. It's that spread. And you're probably not going to get this type of information anywhere else. I have looked around, and it took me forever to get this. It's just not in one video. So if you really enjoyed this video and you found it useful, please like and leave a comment and ask some questions. All right, now the other thing is, you see when the moving averages are all twisted and tangled, that's when the MACD is going flat and sideways, and that is an indication we have a ranging market and we don't want to trade that. So that is how the histogram is represented, okay? So now we're going to talk about the MACD line. The MACD line is the blue line below the chart of the MACD indicator. All it is it's the 12 EMA minus the 26 EMA. It's basically the same indicator as the histogram, but it's put as a line on the chart. So this is the line right there, right? That's it. That's the line. That's the MACD line. Okay. Now, then there is the signal line. The signal line is the 9-period EMA, and it's called the signal line because it gives a signal when price crosses over the MACD line. The crossover can be an indication that price is about to change directions. So then down here you have the signal line. You can see that they cross right here, right? The signal line. So let me go back to the main slide here so you can see you've got the signal line, the MACD line, the baseline, and the histogram. And the signal line, they call it that, is because when it crosses, that's an opportunity to be trading, right? That's an opportunity when you see the signal. They call that a signal line. It's when price is up near the top and we're thinking that we're going to get a reversal, or price is at the bottom, we're going to get a reversal. We want to look at that signal line. That's how the signal line works, right? So, lots of information that I've downloaded here. I want you to think about it. I want you to go over it, pause it, view the video, and in the next video, we're going to talk about strategies on how we're going to trade the MACD. We're going to talk about the convergence strategy. We're going to talk about the divergence strategy, the zero line cross strategy, and the single cross strategy. So get ready for that. I'm going to go over it. I'm going to talk about it, test them, show them how we can trade it, and see all that. Now, if you have any questions about the MACD, or if I missed something, or if you weren't sure about something, please leave a comment below, because I am always looking at these comments. It's really important to me that I'm doing my job as an educator, that I'm not talking too fast. If I'm talking too fast, I'm sorry. There was a lot to talk in here. If I wasn't clear on something, if I missed something, whatever it is, please let me know, because I'm trying to do the best that I can do to help you guys understand how these indicators work and to help you with your trading. All right, well, that's it. We'll see you in the next video, and be looking out for that next video, which has all of the strategies, and I'm going to go in and test them and do a lot of detail on it. All right, thank you, and we'll see you in the next video.